Hello everyone, welcome back to Just Invest Today. In today's video, we are talking about Charlie Munger on the Acquired podcast. This was just a new release podcast like 3 weeks ago. So if you haven't watched it, you have to check it out. He dropped so many lessons, investing lessons, and you have to always take it in because when Charlie talks, he provides so much knowledge and just like background history on stuff. In today's video, we're going to talk about 3 important investment lessons that he displays in this video. So this video dropped the first week of November 2023 and I was super excited. Anything Charlie releases, you have to watch it. Anything Charlie, Warren Buffett, Mohnish Pabrai, I'm so excited to watch these videos because there's so much knowledge that they drop in the videos. So let's get to the first lesson that he displays, and you have to watch the full interview because I'm only going to talk about 3, but there's a lot more in this video. So the first lesson Charlie Munger talks about or displays is that when there's an opportunity in the market, you have to grab it. You have to get it right away because you don't find a lot of great opportunities in the market. So when it provides itself or when it comes out, you have to invest fast and quickly. And Charlie Munger was talking about Costco. There isn't many times in life you know you will be right and will work out wonderfully. Maybe 5 to 6 times in a lifetime. Finding it is very hard and rare. When I think about those lines, I think about Charlie Munger when he bought Wells Fargo in the 2008 recession, and he actually said he bottom ticked it by mistake, but he went full in. He knew the facts beforehand, he knew the business, and he went right away during the whole recession. And that's the opportunity that you have to take when the opportunity is presenting itself. When you find a company that you know and you understand with a competitive advantage, and you see the price get crazy low, you have to take the opportunity. Also, even with like Facebook, like I did the same thing when everyone was against Facebook, when it was like $90, I seen a huge opportunity and I bought. I was selling 2 to 3 companies and I had to keep doing that in order to get that much money to buy Facebook. And I had a huge profit off of that. I was making videos telling people to buy Facebook, but no one was listening to me. Everyone was saying it was a bad company. So when you see these opportunities in the market, you have to take it. It's the same thing with JD.com right now. I'm buying it like crazy because I see this as a huge opportunity. It's getting super cheap. Warren Buffett also talks about this too when he sees opportunities that he can put like 20% positions, 30% positions in it. He did this with the Washington Post. He did this with a lot of other companies. Here's a video where he kind of talks about when you're confident in a position, you have to take charge and like put your money where your mouth is.
I'm Isaac Dimitrovsky from New York City. Mr. Buffett, it's great to be here. I've read that there were several times in your investing career when you were confident enough in one idea to put a lot of your money into it, say 25% or more. I believe a couple of those cases were American Express and the Washington Post in the 70s, and I've heard you discuss your thinking on those. But could you talk about any of the other times you've been confident enough to make such a big investment and what your thinking was in those cases?
Charlie and I have been confident enough, if we were only running our own net worth, I'm certain a very significant number of times, if you go over 50 years, there have been a lot of times when you'd have put at least 75% of your net worth into an idea, aren't there, Charlie?
Well, but 75% of your worth outside Berkshire has never been a very significant amount.
Well, but I'm going back. Let's just assume it was. Let's just assume you didn't have Berkshire in the picture. There have been times, I mean, we've seen all kinds of ideas we would have put 75% of our net worth in.
Warren, there have been times in my life when I've had more than 100% of my net worth invested in things.
That's because you had a friendly banker and I didn't. No, there have been times, well, initially I had several times I had 75% of my net worth in one situation. There are situations you will see over a long period of time. I mean, you will see things that it would be a mistake if you're working with smaller sums. It would be a mistake not to have half your net worth in. I mean, you really do sometimes in securities see things that are lead pipe cinches, and you're not going to see them often, and they're not going to be talking about them on television or anything of the sort. But there will be some extraordinary things happen in a lifetime where you can put 75% of your net worth or something like that in a given situation. The problem has been the guys that have put 500% of their net worth in. I mean, if you look at, just take LTCM, very smart guys, very decent guys, some friends of mine, high grade, knew their business, but they put, maybe 25 times their net worth into things that were a cinch if they hadn't have gone in that heavily. I mean, they were in things that had to converge, but they didn't get to play out the hand. But if they'd had 100% of their net worth in them, it would have worked out fine. If they'd had 200% of their net worth in it, it would have worked out fine. But they instead went to, maybe 2,500% or something like that. So there are stocks. I mean, there's quite a few people in this room that have close to 100% of their net worth in Berkshire, and some of them had it for 40 or more years. Berkshire was not in the cinch category. It was in the strong probability category, I think. But I saw things in 2002 in the junk bond field. I saw things in the equity markets. If you could have bought Cap Cities with Tom Murphy running it in 1974, it was selling at a third or a fourth what the properties were worth, and you had the best manager in the world running the place, and you had a business that was pretty damn good, even if the manager wasn't. You could have put 100% of your net worth in there and not worried. You could have put 100% of your net worth in Coca-Cola earlier than when we bought it, but certainly around the time we bought it, and that would not have been a dangerous position. It'd be far more dangerous to do a whole bunch of other things that brokers were recommending to people.
When you see big opportunities in the market, you have to take it right away. So that's the first lesson. The second investment lesson talks about you have to actually invest in businesses, not just stocks. You have to really look at the business as an actual business, not just a stock that just moves up and down. Invest in businesses, not stocks. It's a lot like gambling. The Robinhood traders don't know anything about companies. They just gamble on it going up or down in price. If I were running the world, I would have a tax on short-term gains and no offset for losses. You always hear Charlie talking about how he hates gambling, how he hates Robinhood traders, because that's all they care about. All they care about is the price action and what the company is looking at in the next month or two. But he's talking about investing in actual businesses. And when you invest in actual businesses, you're going to actually really look at the company, really look at the products, the competitive advantage, the culture, their management. You're going to actually really like the business and hold it long term. And when you're able to hold it long term, you're not afraid of these 20, 30% drops, because your stock will do that. It will drop like a rock eventually. And if you don't understand the company, its culture, the thesis that you have on the company, you're just going to get killed. You're going to get scared out of the position so quickly when the market turns. You just don't know how you're going to feel when the market drops if you don't really know what you own. And the third and last investment lesson that Charlie Munger talks about is all about pricing power. Pricing power is super important because that determines that you have a competitive advantage. If you're unable to raise the price on your product or your service, and if you do so, someone actually goes on to another brand or another service, you probably don't have a competitive advantage. Charlie Munger says that pricing power, there's something about the flavor of ketchup that people are not willing to change brands over. They want Heinz, so we can raise the price of Heinz. But you try to raise the price of Kraft cheese and everyone goes into a rebellion. And that's exactly what Charlie Munger is talking about, is that if you raise the price of Heinz, people will still go out and buy Heinz. They will actually go across the street and buy the Heinz, even if that Heinz is not in that store and there's another ketchup that's cheaper. People don't want it. They love the brand of Heinz. You have to find out if your company has that kind of competitive advantage, because if you don't, sometimes the product or the service, it just kind of gets commoditized because everyone's competing for the same thing and it doesn't have something special about it, and it just becomes a losing cause overall. So you have to make sure that these companies have some kind of competitive advantage over everyone else, so you're able just to raise prices smoothly without any hiccups. I'm thinking about Chipotle when I think about this, because year after year after year, Chipotle raises its prices. The burritos are super expensive, but customers keep coming back. There's always lineups. The share price keeps going up. People keep buying their products. They don't get tired of it. So Chipotle has an amazing brand, pricing power. So yes, they have a moat. They can charge what they want, or they can incrementally raise their prices. When they're facing inflation or they're facing a recession, people are still going to buy their products. And this is very key. Those are my 3 lessons. Watch the whole podcast because there's like 5 or 6 more I can go into. If you actually want the full breakdown, you can kind of leave a comment below or tell me if you want that video. But these are the 3 most important lessons that I got out of it. Guys, like and subscribe to my channel. Peace.